Inflation. It's a word that sends shivers down the spines of investors and everyday people alike. But what exactly is it, and why is it such a cause for concern? In simple terms, inflation is the rate at which prices for goods and services rise over time. Imagine going to the grocery store and finding that your weekly shop now costs 5% more than it did last month. That's inflation at work. While a small amount of inflation is normal and even healthy for a growing economy, high or unexpected inflation can erode the value of your savings and investments. Think of it like a slow leak in a tire. Over time, it can significantly impact your purchasing power. This is why investors are constantly on the lookout for ways to protect their wealth from the erosive effects of inflation. One of the most common ways investors try to hedge against inflation is by investing in assets that have historically held their value or even appreciated during periods of rising prices. This brings us to one of the oldest and most trusted inflation hedges in the world: gold. For centuries, gold has been seen as a safe haven asset, a store of value that can weather economic storms and preserve wealth when other assets falter. But is gold's reputation as an inflation hedge truly deserved, or is it more myth than reality? Let's delve into the historical evidence and examine the arguments for and against gold as a hedge against inflation. Why gold? What is it about this shiny metal that has captivated investors for millennia? The answer lies in gold's unique properties. Unlike paper currencies, which can be printed at will by governments, gold is a finite resource. Its supply is limited by what can be extracted from the earth. This scarcity is a key reason why gold is seen as a store of value. Throughout history, gold has maintained its value even when fiat currencies have failed. Empires have risen and fallen, currencies have come and gone, but gold has endured. This enduring nature has instilled a sense of confidence in investors, particularly during times of economic uncertainty. When inflation rears its head and the purchasing power of paper money dwindles, gold often shines. This is because gold is priced in those same fiat currencies, so as the value of a currency declines, it often takes more of that currency to buy the same amount of gold. This inverse relationship is a key reason why investors flock to gold during periods of inflation. However, it's crucial to remember that past performance is not always indicative of future results. While gold has a long and storied history as an inflation hedge, its performance in more recent decades has been more nuanced. To fully understand gold's potential role in an inflationary environment, we need to examine the evidence and weigh the arguments both for and against this precious metal. Gold bugs, as they're often called, love to point to the 1970s as proof positive of gold's inflation hedging prowess. During that decade, the United States faced stagflation, a toxic mix of stagnant economic growth and high inflation. As inflation soared, the price of gold skyrocketed, rising from around $35 per ounce in 1971 to a record high of over $850 per ounce in 1980. This dramatic surge in gold prices cemented its reputation as an inflation hedge in the minds of many investors. It seemed to prove that when inflation ran rampant, gold was the asset to own. The 1970s weren't the only period when gold shined. Throughout history, there have been numerous examples of gold holding its value or even appreciating during times of economic turmoil and currency devaluation. However, it's important to note that gold's performance during inflationary periods has not always been consistent. In the decades following the 1970s, gold's price was relatively subdued, even during periods of moderate inflation. This has led some to question whether gold's inflation hedging days are over, or whether the economic conditions of the 1970s were unique and unlikely to be repeated. Gold isn't the only asset investors turn to during times of inflation. Real estate and stocks are also considered potential hedges, each with its own set of pros and cons. Real estate, with its tangible nature, can act as a hedge against inflation. As prices rise, so too does the value of land and buildings. Stocks, representing ownership in companies, can also offer some protection. Companies can often pass on rising costs to consumers by raising prices, thereby preserving their profitability during inflationary periods. However, both real estate and stocks come with their own sets of risks. Real estate is illiquid, meaning it can be difficult to sell quickly if you need access to cash. Stocks are vulnerable to market volatility and economic downturns, which can impact their value regardless of inflation. So, where does this leave gold? Gold falls somewhere in between real estate and stocks in terms of risk and potential return.